So, Mark and Vince, this morning, really excited to have a chance to talk with you guys around a great topic, fixing credit, and really about the ominous credit score that determines a lot of what goes on in the buying process. Today, having join us is Vince Ross from Ross Financial Services, and he focuses on credit counseling and helping people with their credit scores. So Mark, when Mark, pre-qualifies or attempts to qualify a person, let's say they have some challenges or things that pop up on their credit, Vince is the kind of person that would be able to take over and step in to help, kind of guide a person to what needs to happen to kind of get them to that next step. So, Vince, I don't want to take any words out of your mouth, but maybe tell the team a little bit about yourself, what you do, and what some of the focuses should be around getting their credit in line, especially for a big purchase such as.
Sure. Well, credit repair is certainly a niche that I deal with. I'm a financial planner, and I run a successful tax business that I've been doing now for about 30 years. And so I'm able to deal with people around various areas in their finances to help determine, who's a good candidate for what. So I can also be able to provide you with some lead streams as well, because I try to educate all of my tax clients that if they're not buying, they need to buy now.
Mm,
And so with that, looking at the whole credit score thing, it seems to be a mysterious maze that everybody deals with and people are getting frustrated with. I try to knock all the mystery out of it, make sure that people have good information and good understanding of what all of it is. They're looking at their utilization. You know, just because somebody sends you a pre-approved authorization for a card doesn't mean you have to take it. Um,
wow.
and you watch these places that just want to run your credit to see if you can get this new flashy card or whatever it is. Or you're trying to buy a car, what have you. I try to steer them away from a lot of that and empower them to be able to make the decisions they want to make, like buying that house, buying that first house, or maybe buying that second house, or that duplex, or triplex, or quadruplex, um, so they can be able to sit on some passive income. Because if you don't have many streams, you're not going to survive in 2023. You got money's got to be coming from more than one place, and I say this to every client. And being able to get on top of what's going on with their credit is very important. And so I hold their hand through the whole credit repair process, but I have them involved in it as well. I'm not going to just take their stuff and then they call me a week later and say, here. No, I'm telling them this is what's going on. This is what you got there, and this is how we're going to fix it. So they are involved in the process as well, so that when we're completed, you have the kind of client that you need to see that's going to be ready and able to get to the closing table. Because at the end of the day, that's what we all want, right?
Yeah, I agree. So, Vince, what is the typical challenge you see with clients that come to you with credit issues? What's the what are the what's like the top two reasons people have challenges with credit that you see?
One of the biggest problems is not knowing what's on their credit report,
Oh,
having stuff that may be 7 to 10 years old that shouldn't even be reported anymore, but it's still reported, and having to spend time going back to places that you don't even remember if you had an account with, trying to remove those things. That's one of the biggest things, not knowing what's on there, because if you begin to think like you're the lender and you see somebody and they've got something they say they're disputing and it's a $700 balance and it's 10 years old, well, my gosh, either at some point you could have just paid it and got rid of it, or disputed it a long time ago.
Yeah.
And so an underwriter is going to look at that and like, why is this person trying to get some more money? So that's one of the first places. And the second area, which seems to be a growing challenge today, is utilization. The banks, well, the people that are lending money want you to keep your utilization under 30%.
Hmm.
We want you to use your credit, but try to keep your utilization under 30%. And if you can't, maybe that purchase was not that important.
Yeah.
Yeah. Vince, that's a really good topic. I would love for you to expand on that, how the algorithms work and maximize your scores, right? If you
Right.
keep your balances under 30%, that gives you the maximum. And there are different FICO systems, right, that measure scores.
Absolutely. And knowing the difference between your payment due date and your statement date, because your credit review is being based on your statement date. So if you know your statement date is the 15th, it doesn't matter that your payment is due on the 25th. You want to make sure that whatever you need to do to get it to that 30% at the statement date is critical.
That's a good point. So because the due date's after the statement date, meaning the reportable. Okay.
Right.
Good point.
Right.
Good point.
Right.
Good.
I found it fascinating that the algorithm looks at that usage rate. What was the correct terminology for that again, Vince? Utilization rate.
Utilization. Yes, utilization.
Right.
They want to see how you're using your credit.
Right.
You know, if you've got a $10,000 card and you're always at 99%, that might scare a lender away because you're already using whatever you got to its max, and it doesn't look like you're managing it well enough to be able to handle it. In the event that you need to pay it off, can you do it?
Right. Right. My understanding, and correct me if I'm wrong, was that the algorithm looks at usage and produces a score based on that usage, and it goes something like this: if this person has this card and they're only utilizing 30%, let's say on $1,000 card, they're just utilizing $300 or less. The algorithm says this person is not in a financially stressful situation. They're using it sparingly.
Yeah.
If that person starts to go into that 80-90% range of utilization, so on $1,000 card, they've now got $900 of debt. The algorithm says this person is struggling. They're using that card too much.
Absolutely. And those are the kinds of things that an underwriter is going to look for right away. I spent a little time working at American Express, and most of what they do is automated. And if you have the classic card, there is no credit limit. They base it on your activity or what you're doing on a regular basis. And whenever you do something that's outside the norm, then they want to get people like myself that were working there to now go in and look at the numbers. Are these numbers adding up? Also, so is it okay to give them an authorization for that plane ticket to Maui or not?
Right.
So
Right.
you your underwriters are looking really closely at your activity. So you could say I make a whole lot of money, but if you make a whole lot of money and you're still not managing what credit you have well, those things can work against you.
Yeah.
Right.
So
Right.
just to recap real quickly, because we're running out of time here, Vince, some of the things that you highlighted that were important that I want to bring out to the viewers is number one, be involved with your credit. Don't to your point, even when you get yourself involved, you're stating, look, you're still going to be working on your credit, meaning that you got to get involved. Know your score. Don't be afraid of your score. Go after it. Find out what the real score is. I think Mark highlighted a website with FICO.com, myFICO.com, to get their score, real score, not the Credit Karma or My Wallet score or whatever else, because those are based on I guess what Mark kind of a formula or something that is not necessarily tied to what your score really is.
Right.
Sure.
It's just a general algorithm that's not going to reflect what your true scores are.
Yeah. And then the two things that you highlight, which are really interesting, is one, know your credit history. I think that was a really good point. People coming to you sometimes don't even know what's on their credit
Absolutely.
report, and I can say, oh my goodness, yeah, you're probably right, because there's times that I've had buyers come back and say, I didn't even know I had this on it or that on it, and I got to get that off or what have you, and it's
Right.
7 to 10 years. So great point there. And then the second one is really about utilization, which I think not a lot of people are talking about. I was actually expecting you to talk about late payments and things like that, but utilization plays so much into your credit score that you may have a good I guess payment history and you're not late or have any bankruptcy or anything like that, but if utilization's over that 30%, that really impacts your score pretty heavily. So
It's a third of your score. Your
yeah,
utilization is a third of your score. So that's huge. That's huge.
it is. So
Vince, but
yeah,
before we go, Vince, could you quickly touch on what we were talking about earlier, that every person does in fact have 3 different scores from each bureau: Equifax, Experian, and TransUnion. A score for a credit card, a score for an automobile, and an automobile loan, and a mortgage loan. Give us your insights quickly on that.
Well, you said it well, because when you're out shopping and you're trying to make some type of a purchase, you need to know that even you can have, and I just dealt with somebody with this just a few days ago. The person had a 750 score, but they could not get approved for a car because their credit was light,
Right.
because their score in the auto sense or secured lending was light. So you're going to need to know what those numbers are. If you're trying to get a credit card, if you're trying to buy a home or a piece of property, or if you're trying to purchase a vehicle. All of those numbers are going to be, they could be similar, but they could be vastly different depending on what you got going on. There needs to be a blend of these things. You need to have a certain percentage that are unsecured debt, another certain percentage of secured debt or collateralized loan, and then a mortgage loan or something like that, a signature loan of 50,000 or better. Those things are going to be when you have those things lined up, it makes for a better total picture.
Yeah, I
Right.
agree.
Right.
Okay. All right, guys. Well, we are out of time. Vince, thank you so much for taking some time out of your schedule to join us this morning. And as always, Mark, it's great to have you on as well, so that we're chatting. And folks, Vince's connections are on the screen as well. Reach out to him if you have any credit questions or any credit help that you need with. Vince will be your guy to kind of guide you through that path, and hopefully today's video will kind of help you down that pathway. So guys, have a great morning, and thanks again. Take care.
Thank you. Bye-bye.